Shares of Chinese tech giant Alibaba are in the spotlight once again today amid continued pressure from Chinese regulators on the company. Deirdre Bosa is here with the very latest. Deirdre, it's down, about 14–15% now just since Christmas.
Yeah, that's right. Losing some $100 billion in market cap over just a few sessions. Well, developments over the weekend, that's putting even more pressure on Jack Ma's empire. Alibaba affiliate Ant Group met with Chinese regulators that set out a 5-point compliance agenda for the fintech giant that would upend its business model, one that was valued north of $300 billion just before it pulled its IPO about a month ago. Now, it includes orders to revamp its credit business and return to its roots in payments. And where Ant's loan model has been asset light, meaning that it didn't take on much of the risk, it would now have to put up more of its own capital and be regulated more like a bank. So these are big changes for this company. Now, the writing has been on the wall since late October when Jack Ma, who founded Ant as a part of Alibaba, criticized the Chinese banking system publicly. Now, he has been a rare, outspoken Chinese CEO, nicknamed the People's Billionaire in the past, but this time it's been different. And Beijing has since moved to regulate Ant and launched an antitrust investigation into Alibaba. Now, we haven't heard from Ma since, and Ant falling very much in line over the weekend. In a statement, the company says that it appreciates the guidance and help and calls the rectification an opportunity to strengthen its foundation. Now, that kind of language, the recent actions, the responses, they've raised concerns that Beijing could be drifting towards a very hard line against not just Jack Ma and his companies, but big tech in China at large, and we could just be at the beginning of a tougher regulatory landscape in China. Now, at the same time, though, Kelly, we have seen in the past that Beijing's bark can be bigger than its bite. So perhaps a key question going forward is whether regulators will actually follow through with the tough talk. We have examples in the past. Many times we've heard about Chinese internet law that hasn't really at all dented their dominance.
Yeah, and I'm curious in his case, if he is just very quiet for a while or if he says anything else about what's happened over the past couple of months and watching that all play out. Deirdre, in the meantime, what are people saying? Because, again, Alibaba, Tencent, JD, these are the companies that global investors have piled into because they've done so well. Now, I guess, like you said, it's a question of, are they also going to go after these internet players, or do they leave them alone for the time being?
It's a good question. The lack of sort of regulatory framework in China has allowed them to become so big and dominant. But take a look over the last few sessions. I know we mentioned Alibaba at the top, but Tencent, Meituan, the Chinese food delivery company, I think combined those three companies have lost some $200 billion over the last few sessions alone. So this is already having an effect. And Kelly, it's so interesting to see how different that is. The effect is on Chinese companies than it is for our own tech giants, which continue to just push higher in the face of greater regulatory scrutiny. But of course, this is China, and the Communist Party don't necessarily need to prove their case to the public to take action. So it could mean, tough times ahead for the companies and perhaps more opportunities for the smaller rivals. But at the same time, think about how many people Alibaba and Tencent hire, they employ in China and globally. So it would be a big hit for the economy in many ways, too.
Shepard Smith here. Thanks for watching CNBC on YouTube.